Taxes are changing again for this year, 2025, for personal federal tax returns. And if you're not paying attention, you could be leaving money on the table when you file in 2026. I'm not going to bury you in every federal tax update, but I am going to cover the big ones that matter most for everyday taxpayers. First up, standard deductions. If you file single, your deduction jumps to $15,000. That's up $400 from last year. Married couples filing jointly, you're looking at $30,000, an $800 bump. And heads of household get $22,500, up $600 from 2024. Next, the tax brackets. The top rate stays at 37%, but the income levels shift a little. You're in the 37% tax bracket if you're single and your income is over $626,350, and it's $751,600 if you're married filing jointly. And here's a big one to watch. If you're single and make more than $197,300 or married filing jointly with more than $394,600, that's the point where you jump from the 24% bracket to the higher 32% bracket. Crossing that line can make a noticeable difference in your tax bill. Please take a look at your screen for the new income levels for the other tax brackets. Thinking about buying a new car? Here's some good news. There's a temporary tax break that could put real money back in your pocket. It's called the car loan interest deduction, and it lets you write off up to $10,000 a year in interest on your qualified auto loans. Here's what you need to know to qualify. The car has to be for personal use, not business. It must have a final assembly in the U.S., and you'll need to include the VIN number right on your tax return. Now, there is an income cap. The deduction starts phasing out at a 20% rate once your income passes $100,000 if you're single, or $200,000 if you're married filing jointly. Speaking of automobiles, here's a change that some taxpayers may not like. If you're in the market for an electric vehicle, take note. The $7,500 EV credit ends for cars purchased after September 30th, 2025. As a matter of fact, clean vehicle credits have been permanently eliminated, but that's not the only elimination on the horizon. Some energy-efficient deductions and credits are also disappearing or being capped. Home upgrades like energy-efficient windows, doors, and solar installations will end after 2025. That means the Energy Efficiency Home Improvement Credit and the Residential Clean Energy Credit vanish. So if you're planning to buy a new EV or thinking about energy-efficient home improvements, the clock is ticking. Acting before these deadlines could save you thousands. Here's a big change for 2025 that could really help taxpayers living in high-tax states. The state and local tax deduction, or SALT, is getting a major boost. The cap jumps from $10,000 all the way up to $40,000 starting in 2025. But there is a catch. The benefit starts to phase out once your income goes above $500,000. But for many taxpayers, especially in places with high state income and property taxes, this could mean thousands more in deductions. For example, a family living in New Jersey paying $16,000 a year in property taxes and another $20,000 a year in state income taxes used to be capped at just $10,000. Under the new regulations, they can now deduct the full $36,000, more than triple what they could before. That's a huge difference come tax time. Let's talk about a couple of other tax breaks that are getting updates for 2025 before we take a look at some brand new tax breaks. First, the foreign earned income exclusion. For Americans working abroad, the amount of income you can exclude rises to $130,000, up from $126,500 in 2024. And then we have the earned income tax credit. If you qualify and have 3 or more kids, the maximum credit jumps to $8,046, up from $7,830 in 2024. And of course, there are different amounts for families with fewer kids, plus income thresholds and phase outs. Please take a look at your screen for other amounts. Now let's talk about a couple of changes that some people may see as bad news. First, personal independent exemptions are gone for good. These were tax benefits used before 2018 that let you lower your taxable income for yourself, your spouse, and each dependent. They were originally supposed to come back in 2026, but now the elimination is permanent. Second, miscellaneous itemized deductions are also permanently eliminated. That means that if you are a W-2 employee, you cannot deduct things like unreimbursed employee expenses. For example, if you buy supplies for work or maintain a home office, you can't use those costs to lower your taxes. But here's the flip side. While some older deductions are disappearing, some fresh opportunities have been introduced, like the overtime deduction, the new tips deduction, and even expanded credits for seniors. So even though some doors have closed, others have opened. These 3 new deductions that I just mentioned are game changers for a lot of taxpayers because they have never happened before. First, there's a bonus deduction just for seniors, worth up to $6,000 if you're 65 or older. And the best part, it's available through 2028. Here's what to know. You can take an extra $6,000 off your taxable income once you hit age 65. The deduction starts phasing out if your income is above $75,000 and you're single, or $150,000 if you're married filing jointly. You'll need a valid Social Security number to qualify, and it's not available if you filed as married filing separately. I have a separate video about the senior deduction. I will put a link to it at the end of this video. Secondly, there's a tax break on overtime. Starting in 2025, workers can deduct up to $12,500 of qualified overtime income each year, and this runs through 2028. The deduction starts phasing out for incomes above $150,000. Please keep in mind, this isn't a dollar for dollar tax cut. It lowers your taxable income, and your actual savings depends on your tax rate. For example, if you're a nurse earning $10,000 in overtime and you're in the 24% tax bracket, that deduction would save you around $2,400 on your tax bill. The third game changer is tips. For tax years 2025 through 2028, there's a new temporary deduction that lets you deduct up to $25,000 in tips. And the best part, you can claim it whether or not you itemize your deductions. Here's a brief summary of how it works. If your income is $150,000 or below, you may qualify, and the deduction starts phasing out once your income goes above that limit. For example, if you earn $5,000 in tips and you're in the 12% bracket, you'd save about $600 on your tax bill. If you want to hear more about the new tips tax break, please click on the video link at the end of this video. Okay, next change. If you get paid through third-party apps or platforms, think Venmo or PayPal or Etsy, the way the platforms have to report income is shifting again. Starting in 2025, those companies only have to send you a Form 1099-K if you received more than $20,000 in total payments and had over 200 transactions on a single platform in a year. But here's the key point. Even if you don't get a form, you're still required to report that income on your taxes. The IRS doesn't need a 1099-K to expect their share. For example, let's say you sell handmade items on Etsy and bring in $12,000 from 150 transactions. You wouldn't get a 1099-K, but you still need to report that income. On the other hand, if you're just sending your roommate your half of the rent through Venmo, that's not taxable income at all. Let's move on to tax breaks for parents. And there's a lot of good news here. Starting in 2025, the child tax credit is getting a permanent boost to $2,200 per child under 17. That's up from $2,000, and it will now adjust for inflation every year. Here are the key details. The credit is $2,200 per child, plus up to $1,400 is refundable. The phase-out thresholds are $200,000 for single filers and $400,000 for married couples filing jointly, and those limits are permanent. To claim the credit, the child must have a valid Social Security number, and for joint returns, at least one spouse must also have a valid SSN. And for families with dependents who don't qualify for the child tax credit, such as parents, adult children, or other relatives, the other dependent credit stays at $500 and has also now been made permanent. There's also a brand new way for parents to give their kids an early start to building long-term wealth. Under the new law, parents of children who qualify can open a special tax-deferred savings account, often called a Trump account, for kids born between January 1st, 2025 and December 31st, 2028. Here's a brief summary of how it works. The government will provide each account with a $1,000 tax-free seed contribution. Parents, family members, or even friends can contribute up to $5,000 per child per year. The accounts come with restrictions on withdrawals and control. Think of it like a 529 college savings plan or even a Roth IRA for kids. The structure is different, but the idea is the same. Build up money now, let it grow over time, and give your child a financial head start. Speaking of a 529 college savings plan, if you have one or if you're thinking about opening one, the plan just got better. The new regulation expands what you can use these funds for, giving parents and students a lot more flexibility. Here's what's new. You can now use up to $20,000 for K-12 expenses, which is double the old $10,000 limit. Funds can also cover extra costs for K-12 education like books, tutoring, or even online learning materials. And for college or trade school, you can use the money for tuition, fees, books, supplies, and equipment, plus new expenses like testing fees for certifications or continuing education programs. For example, if your child is in private high school, you can use part of your 529 plan to help cover tuition and even tutoring. If you're an adult going back to school for a trade certification, you could use it to pay for exam fees and required coursework. Here's some news for adoptive families. The adoption tax credit. For 2025, families adopting a child with special needs or covering qualified adoption expenses can claim up to $17,280, an increase from $16,810 last year. In the past, this credit would only reduce your bill down to zero, meaning if you didn't owe any taxes, you couldn't benefit. But under the new plan, a portion of it is now refundable, which means real money could come back to you as a refund. Here's how that works. Up to $5,000 of the credit is now refundable, and that amount will adjust each year for inflation. For example, let's say your tax bill is $2,000 and you qualify for the adoption tax credit. Under the new regulation, you could wipe out your $2,000 bill and still get $3,000 back as a refund. So instead of just making your tax bill lower, the adoption tax credit can now actually put cash back in your pocket. A much bigger win for families going through the adoption process. Now, let's talk tax strategy. With all of these federal tax changes, it's more important than ever to plan ahead. That means reviewing your income and looking for opportunities to shift income into lower tax years. Smart timing can make a big difference. For example, you may want to bunch deductions, like charitable giving or medical expenses, into 1 year to maximize their impact, especially with bigger changes to itemized deductions coming in 2026. I'm going to make a separate video about 2026 tax changes a little later. But in the meantime, the classic strategies still work. Maxing out your retirement accounts, planning Roth IRA conversions, and harvesting capital gains or losses. Those tools are still on the table to keep your tax bill as low as possible. If you'd like to dive deeper into some of the new provisions I mentioned, I've got more resources for you. To learn more about the new senior deduction, click the video in the upper left of your screen. And if you want the full details on the new tax break for tips, click the video in the lower left. Both will help you take advantage of the changes and keep more money in your pocket. See you next time.